Something really interesting just happened in the market, and most investors are completely missing it. Right now, there are 6 companies, massive companies that you know by name, that just got absolutely destroyed during earnings season. And here's the thing, the businesses didn't get worse. The fundamentals didn't collapse. Wall Street just decided that good wasn't good enough, and they sold first and asked questions later. What that's created is a window of opportunity that doesn't show up very often. And if you understand what you're actually looking at, this could be one of those moments you look back on in 3 or 4 years and realize was a major turning point. We're going to walk through all 6 of these companies today, and I'm going to show you exactly why I think patient investors are being handed a gift right now. Before we get into it, if you're new to Market Edge, this is where we focus on building wealth through intelligent, long-term investing, not chasing headlines or trading noise. If that sounds like your kind of approach, go ahead and subscribe so you don't miss the next breakdown. We're going to be covering a lot more of these earnings opportunities over the next few weeks, and I want to make sure you're here for them. All right, let me set the stage for what's happening. The market right now is in this weird phase where if you're a technology company and you're spending heavily on artificial intelligence infrastructure, you're basically guilty until proven innocent. It doesn't matter if your revenue is growing at double digits. It doesn't matter if your profits are hitting all-time highs. If your free cash flow looks lighter this quarter because you're investing billions into future growth, Wall Street panics and hits the sell button. And you know what that short-term thinking creates? It creates long-term wealth for the people who stay calm and actually understand what they are looking at. This is how generational returns get built, by buying quality when everyone else is running for the exits. So let's talk about the first company, and this one really captures everything that's wrong with how the market reacts sometimes. This is a business that just reported over $700 billion in annual sales. $700 billion. Still growing double digits at that absolutely massive scale. Net income over $77 billion, up more than 30% year over year. This is literally one of the most profitable companies on planet Earth. There's maybe one other company that even operates at this level, and that's Walmart. Nobody else is even in the same universe. But the stock dropped more than 14% in a single week. 14%. And the reason is actually kind of ridiculous when you think about it. Their free cash flow fell about 70%, and that freaked people out. But why did it fall? Because they spent $128 billion on property and equipment, and they're guiding for $200 billion in capital expenditures this year. $200 billion. Now, most investors see that and panic because they see cash going out the door. But let me ask you this. When you see a company that's already generating massive profits, already dominating multiple industries, and they choose to reinvest almost everything back into infrastructure and technology, what does that actually tell you? It tells you they see something enormous coming. They're not doing this because they're desperate. They're doing it because they can afford to, and because they know something the market doesn't fully appreciate yet. That company is Amazon. And here's what most people are missing. Their North America segment, which includes all the e-commerce plus their rapidly growing digital advertising business, just generated about $11.5 billion in operating income. That's almost matching their entire AWS cloud business, which, by the way, is still growing at 24% in sales and 17% in profits. The advertising piece is becoming an absolute profit machine, with much higher margins than traditional retail, and most investors aren't even paying attention to it yet. Amazon could flip a switch tomorrow and become even more profitable if they wanted to, but instead, they're choosing to build for the future. And as a long-term investor, that's exactly what I want to see. So when I see Amazon down double digits because they're investing in the future instead of just returning cash to shareholders today, I'm not worried. I'm excited. This is the buying opportunity. Now, let me talk about investment thinking for a second before we move to the next stock, because this is important. When you're evaluating these situations, you have to ask yourself, am I buying the stock price or am I buying the business? The stock price is just noise. It goes up and down based on emotion and short-term thinking. The business is what matters. And when you find a situation where the business is getting stronger but the stock price is getting cheaper, that's called a margin of safety. That's your edge. That's where real money gets made over time. All right, the second company we need to talk about is down more than 20% from recent highs. And once again, it's all about capital spending spooking the market. They increased their spending by 66% year over year to $37 billion, a few billion more than analysts wanted to see. But here's the context everyone's ignoring. This company just generated $81 billion in revenue in a single quarter, up 17%. Net income hit $38 billion, up 60%. 60% profit growth at that scale is almost unheard of. This is a company that essentially owns enterprise software, owns the developer ecosystem, and is the backbone of the biggest AI platform in the world through their cloud infrastructure. We're talking about Microsoft. And the business is not broken, it's thriving. They're practically printing money right now. Their cloud business is growing at 40% annually and is only behind Amazon in market share. But because they're spending to protect and expand that incredible position, the stock gets hammered. And that creates opportunity because Microsoft rarely goes on sale like this. When it does, history is pretty clear about what happens next. The people who bought during the dips did very well. The people who waited for everything to look perfect usually ended up paying a lot more later. And here's the thing. With all the AI integrations they're rolling out across their entire product suite, the potential is enormous. This is a company that touches almost every business in the world in some form, and now they're making all of it smarter with artificial intelligence. Before we get to the next stock, let me explain something about valuation that'll help you think about these opportunities. Price and value are not the same thing. Price is what you pay. Value is what you get. Right now, the market is giving you the chance to pay a lower price for the same or better value. Microsoft's business is stronger today than it was 3 months ago, but the stock is 20% cheaper. Amazon's competitive position is stronger, their profit engine is stronger, but the stock is down 14%. That's the disconnect we're looking for as investors. Like when price falls faster than value, that's your signal. Now let's shift into the medium risk category, and I want to be clear about what medium risk means. These are still high quality businesses, but they've got a bit more volatility and some specific challenges they need to work through. The first one just had its worst single trading day since 2017, down nearly 20% in a week. And here's what's crazy. Their earnings were actually really strong. They beat expectations on revenue and profit. Sales grew 34% to a record high of over $10 billion. Operating income hit nearly $3 billion, up close to 50%. Their data center business, which is the AI part everyone cares about, grew 39% to $5.5 billion. These are phenomenal numbers. So what went wrong? Nothing, really. Their guidance was strong, even beat expectations according to some reports. But apparently it wasn't a big enough beat to satisfy Wall Street. See, during earnings season, hype sets an impossible bar. It's not enough to just beat estimates anymore, you have to obliterate them. And if you don't, even a solid quarter gets sold off. That's what happened to AMD. But here's why this is interesting. They've got new MI350 and MI400X chips coming. The Helios rack scale AI platform is launching. Major customers like OpenAI and Oracle are on board. Free cash flow just hit a record, and management expects an even bigger ramp in the second half of the year. For years, AMD was playing catch-up, just trying to survive against Intel and NVIDIA. Now they're actually competitive and gaining real ground in both CPU and GPU markets. The dip looks attractive to me, especially if you're willing to handle a bit more volatility than Microsoft or Amazon. It's riskier, but the upside potential is significant. The other medium risk name I want to talk about is down about 10% on earnings and nearly 30% from its 52-week high. And this is one of those situations where the market just completely overreacted. They actually beat on revenue and even raised guidance slightly above expectations, but they missed on earnings per share by literally 5 cents. They posted $2.23 instead of $2.28. Expected 5 cents. And for that, the stock got absolutely destroyed. Nothing about the business fundamentally changed. Growth didn't collapse. The model didn't break. It was just a minor miss on one metric while they beat on another and raised forward guidance. This is VeriSign, and here's why it's fascinating. They own the exclusive rights to .com and .net domains. Think about that for a second. That's like owning some of the most valuable real estate on the entire internet. And while there's competition in other domain extensions, any serious business still wants a .com or .net address. They also manage .gov, and this creates incredibly high renewal rates, very sticky customers, predictable revenue, and real pricing power. In fact, they're allowed to raise prices almost every year under their agreement with ICANN, the organization that oversees internet domains globally. Their costs barely increase because once the infrastructure is in place, it's just maintaining and running servers, but their prices can go up regularly. That means expanding margins over time. Gross margins consistently run above 80%, often closer to 90%. That's an incredible business model. It's not flashy, it's not exciting, but it's profitable and it's stable. After this drop, the valuation is significantly cheaper than both their 5-year average and the sector median. This is the kind of stock you buy and hold for years, collecting steady gains while everyone else chases the latest hot thing. Now let's move into the higher risk category. These are still quality companies, but they've got some specific challenges they need to work through. First up, this stock initially fell 9% on earnings and is down about half from previous highs. There are 3 main issues weighing on it. 1, they're expecting softer international traffic to their theme parks because of inflation, interest rates, and geopolitical concerns. International travel to the US has actually declined for 8 straight months. 2, Their sports and legacy TV businesses are struggling with rising costs for rights and production, plus fewer people paying for cable. Their sports division saw operating income drop 23% and took a hit of over $100 million from a YouTube TV blackout. And 3, they were in the middle of a CEO transition, which markets always get nervous about. That's Disney. And those are real issues. I'm not going to sugarcoat it. But here's what's being overlooked. Disney actually beat expectations on both revenue and profit. Their experiences division, which includes theme parks, resorts, and cruises, just generated over $10 billion in revenue in a single quarter for the first time ever in company history. And here's the key part. That division makes up only 38% of Disney's total revenue, but generates over 70% of their operating profit. It's the engine keeping everything else running, and the guy who built that success, Josh D'Amaro, is now the new CEO. He's proven he can run a profitable operation at massive scale, and that's exactly what Disney needs as they fix streaming, sports, and legacy TV. Speaking of streaming, we're finally seeing real progress. For years, Disney Plus and Hulu were burning billions. They were money pits. But this latest quarter showed streaming revenue jumping double digits, and they're projecting around a $500 million increase in operating income for the current quarter. That's a massive improvement. That's real money hitting the bottom line instead of disappearing into content costs. So you've got a stock down 50%, a proven CEO who built the most profitable part of the business, that division firing on all cylinders, and streaming finally turning profitable. Yeah, there are challenges, but I think investors are being way too short-sighted. This is probably still the strongest media and entertainment company in the world with an unmatched content library and brand recognition, and it's trading like it's broken. When you can buy quality at distressed prices, that's usually when the best returns get made. Finally, let's talk about the last stock. Down 30% in the past month and over 50% in the past year. Absolute bloodbath for shareholders. And just like the others, their earnings were strong. They beat expectations. The business is growing. Demand is high. But investors wanted perfection, and when they didn't get it, they sold hard. A Morgan Stanley analyst literally said their earnings were good, just not good enough. Well, that's created a buying opportunity in my view. This is ServiceNow. And fundamentally, this is one of the strongest enterprise software companies out there. They run digital workflows inside massive corporations, handling IT, HR, operations, customer support, all the behind-the-scenes infrastructure that keeps these companies functioning. And once they're embedded into an organization, they almost never get ripped out. Renewal rates are close to 100% because companies become completely dependent on the software. It becomes part of the nervous system of the organization. Now they're layering AI on top of everything. Chatbots, automation, virtual agents, all designed to help companies run leaner and more efficiently. Despite a tough macro environment, their customer accounts keep growing, and those customers keep spending more. That tells you the value proposition is real and it's working. The main risk I see is competition from giants like Microsoft, Oracle, and Salesforce moving deeper into this space. They're not direct competitors across the board, but there's overlap, and that's a concern. When you're competing with companies that have essentially unlimited resources, you have to stay sharp constantly. But with the stock down as much as it is, and considering the consistent growth and record profitability they're putting up, I think that risk is already reflected in the price. The valuation is over 50% cheaper than their 5-year average, and more than 30% cheaper than the sector median. At these levels, this is starting to look extremely attractive. So there you have it. 6 companies that got sold off hard during earnings season. Amazon, Microsoft, AMD, VeriSign, Disney, and ServiceNow. And in my opinion, all of them deserve a serious look right now. If you're thinking about the next 5, 10, 15 years rather than the next 5 months, these are the kinds of opportunities you should be paying attention to. The market gives us chances like this periodically, and the investors who take advantage while everyone else is panicking are usually the ones who build real wealth over time. Let me know in the comments which ones you're most interested in, or if you already own any of these. And if you found this breakdown valuable, share it with someone who might benefit. It really helps us keep bringing you this kind of analysis here at Market Edge. If you want to keep learning about these opportunities as earnings season continues, check out our other videos breaking down the market. Thanks for watching, and remember, this is educational content, not financial advice. Always do your own research and consult with a financial professional before making investment decisions.